So this guy apparently invested $1 million in the Bloom Energy stock, which is a bold move.
You put $1 million in Bloom Energy.
Yeah, I have a lot more than that in Bloom Energy because big tech is spending $650 billion this year to build out more compute. However, compute is bottlenecked by energy. And counties are saying, hey, if you data centers are going to suck up all this energy, you can't do that and screw the people that live here.
This is actually a big issue right now. This was actually even in the State of the Union for the United States. Not going to get political here, but they know, the entire government knows, the citizens that are near these data centers know that power is going to get really expensive for the average person if they don't figure out this problem. So he does have a point there, but we have to figure out which companies are actually going to capitalize on that and actually be the biggest beneficiaries of the energy demand that these massive data centers are going to have.
So there's this new legislation where you got to bring your own energy, right? Like if you want to build a data center here, fine, but figure out your own energy.
So that was actually a part of the State of the Union. So the president, the government in the United States, they're saying to these companies that are building AI data centers, you have to supply your own energy. You cannot make a negative impact on the grid for all the other average people that have nothing to do with these data centers just because you are investing hundreds of millions of dollars in AI.
They're not going to increase our energy costs for our residents. And Bloom Energy is one of the only companies in the world that has a method to bring almost an infinite amount of energy to these data centers.
So very little detail, of course. It is a YouTube short, but you'll have to look at the Iced Coffee Hour and watch their full video to get the full story. But I'm going to go over whether or not this looks like a good investment right now or in the near future and see if this company actually makes sense for different scenarios. Now, he mentioned, they can create like unlimited energy and supply it to these data centers. Well, actually, that's a bold thing to say, of course, but they are a leading company that provides on-site clean and reliable energy solutions using solid oxide fuel cell technology. So they generate electricity through an electrochemical process without combustion using natural gas, biogas, or hydrogen, which reduces emissions and provides uninterrupted modular power for data centers, hospitals, and manufacturing, which does sound good in theory. So there are a few potential downsides here. One is fossil fuel reliance, so they actually use natural gas, and some actually argue that this could produce more CO2 per megawatt hour than the local grid. Also, hazardous waste could be an issue as well, because the process that they use for cleaning natural gas before it enters the fuel cell, it creates a toxic hazardous waste byproduct. This is my biggest concern. I was worried about a company like this, another electricity company that sounds good in theory, but a lot of these companies don't seem to have consistent profitability, or they are banking on long-term gains and can't really show much profit right now. So apparently they have high operating costs for this type of procedure as well, like material wear and tear. It typically operates at a very high temperature of up to 1800 degrees Fahrenheit. They also have to replace the internal fuel cell stacks every 4 to 5 years, which sounds pretty frequent actually. And the hardware for all of this is quite expensive. So this could be one of those companies that has this amazing possible long-term solution to energy, but they're maybe too futuristic, or they are not able to consistently turn a profit right now. But we'll get into the numbers. Now, if we look at the past year, Bloom Energy is killing it for their stock. So they're up 625.9%. I hope this guy bought $1 million worth of shares before all that happened. That way he would have been doing really well for himself. But as far as the past 5 years, they're up 543%. So most of their growth actually came between 2025 and early 2026. So they had this huge spike. They weren't doing much before then. Before 2025, they did have a spike at the end of the year, but they were mostly trending downwards since their IPO, looks like. So they actually IPO'd back in 2018 and hadn't done much stock-wise until the end of 2025. They're also up 11.83% in the past month. Past 6 months, up 200%. They're not showing a dividend, so you're basically banking on this having high growth. PE ratio doesn't show a PE ratio on Google. A lot of times that's a bad sign. So we'll get to that in a second and look at some other alternate sources for that information. Quarterly financials, their revenue as of December 2025 was up 35, almost 36% year over year, but their net income down almost 100%, diluted EPS down 100%, net profit margin down 99%. As far as earnings, they typically have beaten on EPS by a lot. Revenue, they've done really well, beating expectations constantly. Now, if you compare their returns to the S&P 500, which is part of what I do here and what I believe is the gold standard, then you would have actually outperformed the S&P 500, mostly because of the spike from 2025 to 2026. But of course, that doesn't mean that'll continue. Now, if we look at assets versus liabilities, they've got a 4-to-3 ratio there. I'd like to see that a little bit better, but that's not like a deal breaker or anything. If you look at return on assets and return on capital, those are actually pretty solid numbers, or at least decent, I would say. Return on capital and return on assets, usually you want to see like 5 to 10% or more on assets and 8 to 15% or more on return on capital. It says they have massive demand for their fuel cell servers from AI data centers and a $6 billion backlog. So that's good news. They also have a $5 billion partnership with Brookfield Asset Management for AI infrastructure as well. And as far as analyst outlook, Morgan Stanley actually raised their price target to 184 in February 2026. So they're raising outlooks. That's also a great sign. But of course, they do have a very high reliance on the AI data center sector and high valuation compared to some of their sector peers. I also like to look at the past 3 months because that's the equivalent of a quarter of a year, and they are up almost 60% over the past 3 months, which is well above what the S&P 500 has been doing. Now, if you look at the price to earnings ratio here, this is concerning. It's negative 401.73. That's probably the lowest I've ever seen if you count negatives. So they don't seem to be profitable, which is concerning. Now, we do have a lot of Robinhood customers buying over the last few days. Hedge fund managers, we do have more hedge fund managers buying, or at least buying more shares overall than selling Q4 2025. Before that, mostly selling a couple of quarters before then. Now, analyst ratings are very mixed on this, so that's interesting as well. So Wall Street analysts actually give them, out of 31 ratings, a 42% buy score and a 42% hold score, and a pretty high sell score for these typical ratings here. Normally, a sell score for a company that's considered a buy is very low. It's like in the single digits, maybe like 2 or 3% on most of them. Buy or hold, 42%, sell 16%. So the hold and sell scores are higher than a lot of stocks that I've looked at lately, and that is concerning as well. Analysts seem to be pretty split on what to do here. As far as earnings, they have been beating on earnings the last few quarters, or at least over the past year. But of course, that's when they've had their big spike in their stock. Before then, they were missing in 2024. So it looks like they actually lowered guidance from Q4 to Q1 2025 to 2026. But another alternative that I like to look at to a PE ratio, which in this case, PE ratio is almost useless because they seem to be not profitable. But if you look at the EV to EBITDA ratio, now currently it says it's a 2,463. That's insanely high. That probably is the highest I've actually ever seen out of a stock I've reviewed. And then if you look at their EV to EBITDA ranked versus other companies in the industrial products industry, they are ranked worse than 99.39% of the other 2,455 companies. Also a really bad sign, but only a small indicator. The industry mean, by the way, is 16.49, whereas theirs is a 2,400. Now the PEG ratio here is actually a 6.25. So typically, to put that in perspective, a 1 or 2 is what you're looking for a lot of times, and that's usually a bargain for the price to earnings growth over time. Now, this is like 3 times what you're normally looking for, which is usually not a good sign in terms of whether or not this is a good buy right now. Now, obviously not financial advice, and there's a lot of indicators that can go into this depending on how you rank these, but not one indicator here is really a make or break usually. But that is typically, if you look at PEG ratios, that's quite high. Now, if you look at Glassdoor, I also like to look and see like what's the best way I can determine leadership at a company. And typically that goes by how the employees talk about working somewhere or how they rate it at the workplace. So Bloom Energy has a 3.2 out of 5 rating, which is pretty standard. 57% recommend working here to a friend. 56% approve of the CEO. So barely over average in terms of approval there. Not a big red flag or anything, but is it exceptional? No, it's definitely not. So some other things I want to add here about Bloom Energy, and then we'll make a case for buying, holding, or selling Bloom Energy. So one thing that could be interesting in the future, or maybe even in other administrations for the US, is governments, if they subsidize hydrogen, clean energy, grid alternatives, if we go back to prioritizing clean energy in the future with other administrations, they could benefit from that because these fuel cells could eventually run on hydrogen. But of course, that's probably not going to happen right now in the current administration. We also know that microgrid demand is a huge deal because they have actually been told, these AI companies that are building these data centers, they've been told by the government that they have to supply their own energy. So the bull case here, or the buy case here, is data centers need reliable energy. They can supply it. There's a huge future market here because of microgrids, possible hydrogen power in the future, clean energy, although it does create some byproducts and some other issues possibly. They could also secure some long-term service contracts as well because we know AI and these data centers are not going anywhere. We know they're the future. So the hold case would basically be like if you already have some, you've probably already sold yourself on it using some of the factors I already showed you, but you may not want to buy more in this scenario because you're not sure about their profitability, and their stock growth mostly came in the past year, which a lot of times a company will have a massive spike and then they will level off after that. You just don't know. But a high PEG ratio, a negative PE ratio, a very high EV to EBITDA ratio, average leadership scores from employees. There are a lot of unknowns here, so if I already had Bloom Energy, which I don't, I probably wouldn't just go and keep buying more, especially because you're buying at an all-time high right now if you do. Now, the sell case here, if you were trying to convince yourself to sell and you already had Bloom Energy, they don't have steady profits yet. Again, we've seen the negative PE ratio and all of that. We've looked at their quarterly financials where net income, diluted EPS, and net profit margin are way down. We know that their system, their fuel cell systems, are actually expensive to manufacture as well. And there could be a lot of competing technologies for producing energy. We know there's a lot of different ways to produce energy, and other major companies will be trying to get a piece of that pie. We're talking natural gas turbines, batteries, nuclear, etc. And historically, hype cycles are a big deal with clean energy. They actually have very high boom bust cycles with clean energy. To me, this is a classic high risk, high reward type of deal. If you're right, you could multiply your stock value. If you're wrong, it could sink quite a bit. So it's hard to say. For me, I don't see all the things that I need to see for me to get involved with this. I like the idea and I'll probably keep it on a watch list. But for me in my scenario, I'm looking for growth and overall returns. And Bloom Energy, it just doesn't fit my pretty strict criteria yet. But none of this is financial advice. Your situation could be totally different from mine and it might make more sense for you.